Good afternoon and welcome to Advanced Asset Management Advisors Quarterly Market Commentary Review. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is Phil Volker, my business partner and AAMA's Chief Investment Officer. Hey Phil, how are you?
Good, good. Thanks.
Super. Before we get into the guts of our commentary, I wanted to take a couple moments to review AAMA. AAMA is an independent investment advisory firm, and our work is fundamentally rooted. We seek to add value by tilting portfolios toward attractive market segments through our market pricing and sector valuation investment discipline. Our highly experienced investment team with over 30 years of average experience spends a lot of time and effort in evaluating the stock and bond markets. We believe we deliver a team approach which allows advisors to speak directly with Phil and myself. We provide a collaboration and an investment process that is easy to understand, track, and most importantly, discuss with clients. Now, in our commentary, we refer to inflection points. And inflection points normally consist of winners, losers, and normally some significant market volatility. And inflection points are easy to identify in hindsight, but very hard to identify and manage in the moment. The buggy whip industry provides a perfect example. The inflection point was gradual and clear. Automobiles were the future, but there were hundreds of automobile-related companies that tried and failed to capitalize on the market shift. And the lesson, inflection points, even gradual ones, are often accompanied by significant and widespread volatility, which consists of high risk along with the potential for high return. Now, Phil, let's take a couple minutes and talk about inflection points in regards to inflation and interest rates. Can you give us some of your perspective?
Sure. First of all, the reason that we're comparing this inflection point to the buggy whip industry is the fact that the buggy whip industry didn't disappear overnight. It took years as transportation systems were revised. And if you think back to 2009, it's been 14 years since the beginning of what we call the great monetary experiment. And the Fed has kept interest rates low, built their balance sheet from under $1 trillion to close to $9 trillion, and all in an effort to stimulate the economy, liquefy the banking industry. But it's been a 14-year experiment. So if we look back at the last few years, we'll see that both inflation and longer term interest rates started to accelerate from the pandemic lows in June of 2020. Those are highlighted in the box on the left side of the chart. And it wasn't until almost 2 years later that the Fed began to raise interest rates in March of 2022, as you can see in the second box. So we had an inflection point in inflation and long-term rates early on, followed by the Fed in 2022.
And we've consistently said that we do not expect a Fed pivot unless something will break or broke in the system. And that remains the same today. Now, can you take a couple minutes and go through short and longer term interest rates?
Sure. As the Fed raised rates starting in March 22, short-term rates were higher than long-term rates. We can see, looking just at the last several months, the 2-year bumping along around 5%, the 10-year starting at 4 and now at 470. So we've had an inverted yield curve for roughly a year, which is one of the most consistently accurate predictors of a recession. And we still haven't had a recession. The 13 years of monetary ease and now stimulative fiscal policy has probably kept us out of a recession. But the one thing that we've been talking about for some time is we expected once the Fed sort of got where they wanted to be, that longer term rates would start rising and building in a higher inflation expectation. And that's exactly what's happened over the last 3 months. You can see the 10-year rate is up 91 basis points, the 2 years up 16 basis points. So we're building in a bigger term premium in the yield curve, which is primarily reflective of increasing inflation expectations. The other side of this story is supply and demand in the market. We have the US Treasury as a seller of roughly $2 trillion of paper a year. The Fed's quantitative easing or tightening, I should say, program is about a trillion a year. And China is no longer a buyer. They've been letting things run off from originally 2 trillion down to now 800 billion. And maybe the wild card in the supply demand is Japan, because the yen had been a very cheap currency to borrow and buy US treasuries. Now that rates are starting to rise in Japan, that process is less lucrative and could add to supply in our market.
And just so everyone understands, why do we call the 10-year the smartest kid on the block?
Yeah, the 10-year is a global asset that, as I mentioned, you find Japan, China, just about every other country in the world looks at the 10-year as the benchmark rate. And if you think back a couple slides, we saw the 10-year bottom exactly when inflation bottomed, and it hasn't let up yet. So the 10-year Treasury market is a reflection of millions of investors around the world and was close to 2 years ahead of the Federal Reserve in recognizing the inflation problem.
It's amazing what can happen when you get a lot of buyers and sellers openly agreeing on the price level of interest rates. Now, let's take a look at the economy and kind of share some of our ideas, Phil, with our listeners.
Sure. As we've been saying now for the last couple of years, we did not expect a recession, especially when a lot of these typically reliable recession indicators starting flashing caution roughly a year ago. The money supply decline, the inverted yield curve, etc. But the wealth effect that was built into the market over 13 years, and as I mentioned earlier, the fiscal spending situation have probably propped up the economy. 70% of our economy is consumption based with the consumer, and these four segments of the economic structure you'll find constantly updated on our website. But currently, we rank consumption as high and stable, and investment and net exports is fair and stable. Government spending fair, probably weakening. It's been very strong recently or the last several years, but it's probably weakening with some of the political wrangling that's going on in Washington. So net, especially with 70% of the economy on consumption, these are the reasons that we have not been expecting that widely advertised recession.
And I was just listening to a report this morning that said that the consumer has actually saved a lot more billion in dollars than what a lot of the markets have estimated from COVID and being shut down and working from home. Even though there's been a lot of consumption, they've been able to save a lot of funds, which has probably helped keep the recession risk low too.
And that's correct.
Let's take a look at what's happened since March of 2022 to some of the total returns of the securities markets. You want to share some of those numbers with us?
Sure. The whole concept is that rising interest rates affect the valuation of securities. Clearly, bond prices decline when rates go up, and the discounting rate for equity valuation also changes because stock prices discount future earnings at a rate. And if rates are zero, there's really no way to properly discount forward earnings. So if we look at a few select items, long-term treasuries have a fixed return. It can't go up and down unless you buy tips, but most of the treasury market. So the last year and a half, long-term treasuries have lost roughly 30% in total return. And that's simply a function of higher rates. Initial public offerings, similar decline, 26%. Those are companies with what we call elusive earnings prospects because they're not proven companies. They're just an idea with no proven track record typically for earnings. Bitcoin has no earnings. So again, there's nothing to discount there, down 29%. The average stock, based upon the unweighted average, down 5%. And the tech heavy NASDAQ 100 is actually up from when the Fed started to raise rates. It's up 5.5%, higher growth prospects. So the discounting mechanism there hasn't been as severe. Now, we have to point out that stock prices were already down 15 to 20% before the Fed started increasing rates. So, but these numbers we decided to date just from when the Fed started to raise rates.
And give us a little perspective on the market so far this year in 23.
Yeah, the market, if you just look at the headlines, the S&P 500 is up 13%. If you look at the unweighted average of the S&P, which counts each stock equally, is up 1.7%. So that right there shows how a handful of large capitalization companies have really driven the market. And then interestingly, the Dow Jones Select Dividend Index is down 7.8% for 9 months. These are companies that go through a dividend screen, earnings screen, dividend coverage screen. So they're not defunct or ready to be defunct companies. They're operating companies with 5 years of earnings history, basically stodgy dividend paying companies, down 8%. So the market has not been a friendly place this year to date, except for the fabulous seven or whatever you want to call it in the high tech area.
And if you didn't own those seven or so stocks in a market weight position, you probably wouldn't have a return anywhere close to the S&P 500 year to date.
Right.
So where do you think we can find some value this year?
Well, in our sector valuation process, we've been positioned in a partially defensive portfolio for several years now. And if we look at some of the rankings that we use to value sectors, you'll find some green scattered on here, which is good, some orange, which is not good. And it's hard to see clearly exactly what stands out. But healthcare, for example, you can see green across the screen. It's currently valued in the 50th percentile of its historical valuation range and has double-digit earnings growth over the next 12 months. That's the only sector at median or better with double-digit earnings growth expectations. And price volatility for 1 and 5 years is less than the market, and earnings volatility is less than half of the market. Healthcare stands out. It's been an overweight for us for the last several years in our partially defensive position. And we could then look at financials, for example. Financials look cheap because they're at the 20th percentile of their historical valuation level, but earnings forecasts are minus 7%, and price volatility is 25% higher than the market, and earnings volatility 70% higher than the market. So even though it looks cheap, the earnings and volatility are concerning, and financials have been an underweight for us during this period of transition to higher interest rates.
So how would you summarize and conclude some of our market observations?
Well, first of all, we think inflation is not going to go away right away. And that means that the Fed is not going to pivot to lower rates until well into next year. And if you follow the headlines over the last 12 months, a Fed pivot had been widely advertised by the media as happening as early as the fall of 23. And every time, actually early in this year, January of 23, every time those expectations were built into the market was disappointed. And it's happened three, four, maybe five times now where the market expectations were lost for various reasons. So we still think that inflation is not going to easily come down. And so therefore a Fed pivot is further delayed well into next year. As I mentioned earlier, recession probabilities remain low currently, probably increasing somewhat as next year progresses. As Bob, you mentioned, excess savings have been declining. They're not gone, but they've been declining, and inflation is still a challenge for the typical consumer in the United States. We also expect longer term rates to remain higher as the inflation works into the longer term outlook. We've seen the 10-year increase by 90 basis points in the last 3 months, even while the Fed has had little change in their positions. So we are maintaining a relatively short maturity structure and high quality in our bond portfolios. And again, that's the same kind of strategy we've had for the last 3 years, because with zero rates and the potential for inflation increasing, we have maintained a very conservative bond position. As far as the stock market is concerned, we looked in detail at a couple sectors, and again, our position hasn't changed for several years because the stock market has remained moderately overvalued. We've had a decline in corporate earnings. There's hope for recovery over the next 15 to 18 months, but until that's in the bag, it's a speculation. So our position is still that defensive sectors should have a significant representation in the portfolios. So bottom line is the equity market, we're focused on large cap with a tilt towards defensive sectors. And one of the key things that we focus on in today's environment is balance sheet quality and the quality of earnings. So, debt levels is very important to keep track of. One of our metrics and screens right now is debt to EBITDA, which again has been a quality screen we've been using now for several years. And I already mentioned the fixed income portfolios, 100% domestic, short maturity, high quality, pretty defensive positioning there. And again, for the last several years.
Thanks for covering a number of those items, Phil. Really appreciate that today.
Sure. I would also say that, those portfolios, core portfolios, have uh, experienced considerably less volatility than the markets over the last few years. Even though we haven't changed our position, we've missed a lot of the volatility, especially in the bond market. The bond market weakness has been dramatic and historic.
Yeah, it's been devastating if you've been in long-term treasuries or long-term corporates at times. So, well, we'd like to thank our listeners today for taking the time to listen to our perspective. Phil, thanks for detailing a lot of the data today. And as always, I encourage any of you to call us if you have any questions on our portfolios or how our work may be effective in assisting you in meeting your clients' investment goals and dreams. Again, thank you.